You know, the Indian Income Tax Act can feel, well, a little intimidating. It's this maze of rules, sections, and forms. But what if we thought about it in a totally different way? Not as a dense rulebook, but as a journey, a logical path that every single taxpayer takes, right from earning their first rupee to filing that final return. So let's start that journey together.
And really, that's the big question, isn't it? It all boils down to that. How does this massive system figure out who owes what? Well, today, we're going to trace that exact path. We're going to follow the money, follow the rules, and see exactly how the law figures out your tax liability, step by logical step.
So, our journey has to start with the most basic question of all. In the eyes of the tax law, who are you? Before even 1 rupee can be taxed, the law has to define who, or what, can actually be a taxpayer. This is step 1, and it's probably the most important step in this whole process.
Now, you might hear the word person and think, well, that's just you and me. But under tax law, oh, it's way, way broader. We're talking about a family business set up as an HUF, a huge corporation, a partnership firm, even things you wouldn't expect, like your local municipality or university. The law casts this super wide net to make sure no income-earning entity can slip through the cracks. It's basically the law's way of putting all economic activity on the map. Okay, so if the law defines millions of entities as a person, the term assessee is where it gets specific. An assessee is a person who is now officially on the tax department's radar. You might be an ordinary assessee, paying tax on your own income. Or you could be a representative, like a parent filing for a child. There's even a thing called an assessee in default for someone who messed up. The point is, once you're an assessee, you are officially in the tax game. And this quote from the Supreme Court, it just perfectly explains the why behind some of these strange-sounding terms, like a deemed assessee. Just imagine this. A taxpayer passes away before they can pay their taxes. So what happens? Does the tax just disappear? Nope. The law creates what it calls a legal fiction, where the legal heir becomes the assessee for the deceased's income. It's a really practical tool to make sure taxes get collected fairly and nobody can just sidestep their obligations. All right, so we figured out who can be taxed. The next big question is, what income actually gets taxed? And the answer, maybe surprisingly, has a whole lot to do with your location. Seriously, your physical presence in India during the financial year is a total game changer for your tax bill. Let's dig into how that works. This flowchart here breaks it down really nicely. The main test is super simple. Were you physically in India for 182 days or more in the last financial year? If you nod yes to that, boom, you're a resident for tax purposes. If not, okay, things get a little more complicated with some other conditions to check. But that 182-day rule, that's the main gateway. And this is where it all clicks into place. Just look at that first column for a resident and ordinarily resident. See how it says yes for pretty much every type of income, even money earned outside of India? That's because they're taxed on their global income. Now compare that to a non-resident, way over in the last column. They're only taxed on income that's connected to India. This is a huge, huge difference, and it's absolutely central to how your tax liability is calculated. Okay, so we know who pays and on what basis. Now we get to the fun part, calculating the actual income. The Income Tax Act sorts every possible kind of income into 5 neat heads, or buckets. You've got salary, house property, business or profession, capital gains, and other sources. For our little explainer here, we're going to zoom in on the one that applies to most people, income from salary. Now, the word salary sounds pretty straightforward, right? But in the world of tax, it's really more of an umbrella term. There's one absolute rule. There has to be an employer-employee relationship. Once you have that, pretty much any payment you get for your work can fall under this giant umbrella and get taxed as salary. And here's the full picture. Your taxable salary isn't just your basic pay. It includes cash payments called allowances, like for your house rent. It also includes non-cash benefits, which have a fancy name, perquisites. Think of a company car or a place to live. Heck, even your employer's contribution to your retirement fund can get taxed if it goes over 12% of your salary. So the big takeaway here is that salary is the total value of everything you get from your job. The tax system isn't just about taxing your wins, it's also got rules for when you take a loss. And this is a really important part of making the system fair, especially for anyone running a business or making investments. The law gives you 2 main tools to deal with losses: set off and carry forward. Let's break this down. First up, you've got intra-head adjustment. Just think of it like balancing things out within the same income bucket. So if you have 2 businesses and one loses money while the other makes a profit, you can use that loss to cancel out some of the profit. Simple. Now, if you still have some loss left over, you can move to interhead adjustment. That's where you use the leftover loss to reduce your income in a different bucket, like using a loss from a rental property to lower your taxable salary.
But what happens if you don't have enough income this year to use up the whole loss? Well, that's where carry forward comes to the rescue. This table shows that you can basically save most losses and carry them into the future for up to 8 years. But look closely, there are rules. A business loss can only be used against future business income, and a capital loss can only be used against future capital gains. It's the system's way of making sure your tax bill reflects your finances over the long haul, not just one single year.
Okay, and this is a big one, so listen up. If you want to get the benefit of carrying forward those business or capital losses, you absolutely, positively must file your income tax return on time. If you miss that deadline, you lose the right to use those losses to lower your taxes in the future. It's a really strict rule, and you don't want to get caught out.
This brings us to the end of our taxpayer's journey, the final stretch. This is all about the practical stuff, actually filing your return. And, just in case, knowing your rights if you happen to disagree with the tax department's calculations.
Honestly, filing your return online these days is pretty streamlined. The portal pulls in a ton of your info automatically from your employer and your bank, so the process is basically logging in, picking the right form, checking that all the pre-filled info is correct, adding anything that's missing, and hitting submit. But don't forget the last critical step. You have to e-verify it, usually with an Aadhaar OTP. If you don't verify it, it's like you never filed it at all.
So, what if you do everything right, you file your return, and you get a notice from the tax department that you just don't agree with? Well, you don't just have to take it. The system actually gives you a clear 4-stage path to appeal that decision. You start with the Commissioner of Appeals, and you can potentially take it all the way up to the Supreme Court. It's your right to challenge a decision if you think it's wrong.
For that very first step in the appeals process, you've got to follow the rules. The appeal needs to be filed online using something called Form 35, and you've got a strict 30-day window from the day you get the order. It's just a little reminder that while the system gives you rights, it also expects you to act on them promptly.
So there you have it. From defining a person all the way to a final appeal at the Supreme Court, we've traced the entire taxpayer's journey. It's a system with an incredible amount of detail, designed to be thorough and, with things like loss adjustments and appeals, to be fair. But it does leave us with a pretty big question to think about. Does this complicated journey really represent the best way to balance fairness with simplicity? Or could there be a simpler path that gets us to the same goal? That's definitely something worth pondering. Thanks for joining me.